What most people don't realize is that wealth insurance isn't something you buy from an insurance company. It's not a policy with monthly premiums or a claims department. The wealthiest families in history understood something that's been deliberately obscured from the average person. Real wealth insurance is something you hold in your hand. It's tangible. It's been recognized as money for over 5,000 years. And right now, it's sitting at price levels that represent one of the most compelling opportunities we've seen in decades. I'm talking about silver. But before you think this is just another precious metals pitch, let me show you what's actually happening in the markets right now. Because the story unfolding is unlike anything we've witnessed before. The fundamentals driving silver today are completely different from any previous bull market, and the implications for anyone holding paper assets are profound. Let's start with something most analysts are missing. Silver isn't just moving higher because of inflation fears or currency debasement, though those factors are certainly in play. What's happening right now is a perfect storm of industrial demand, meeting investment demand at precisely the moment when above-ground supplies are at their lowest levels in modern history. Think about that for a second. We're running out of available silver, while demand from multiple sectors is exploding simultaneously. The solar industry alone is consuming silver at rates that would have seemed impossible just a few years ago. Every solar panel requires silver for its photovoltaic cells, and as the world races toward renewable energy, that demand isn't slowing down, it's accelerating. Electric vehicles, 5G infrastructure, medical applications, water purification systems. Silver isn't just a monetary metal anymore. It's become absolutely critical to the technology that defines modern civilization. And here's the kicker. There's no substitute that works as well. Scientists have tried. The electronics industry has spent millions trying to find alternatives. Silver's unique properties, its conductivity, its reflectivity, its antibacterial characteristics, make it irreplaceable in countless applications. Now layer on top of that industrial demand the investment demand that's building. Central banks around the world have been accumulating gold at record pace, but what's flying under the radar is how institutions and wealthy individuals are positioning in silver. They understand something that's about to become obvious to everyone else. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of human history, that ratio averaged somewhere between 15:1 and 20:1. Right now, we're seeing ratios that suggest silver is dramatically undervalued relative to gold. When that ratio reverts to historical norms, and it always does, eventually the move in silver will be explosive. But let me take you deeper into what's really happening, because the surface level analysis misses the most important part of this story. The silver market is tiny compared to other asset markets. The entire above-ground investment-grade silver market is worth less than the market cap of many individual tech companies. That means when serious money starts flowing into silver, when pension funds and sovereign wealth funds begin allocating even a small percentage of their portfolios to physical silver, the price impact will be dramatic. We're not talking about a gradual rise. We're talking about the kind of move that changes generational wealth. Quick note here. If you're watching this and you're concerned about protecting your wealth in this environment, I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No cost, just practical information you can use. Now, let's talk about what happened in previous silver bull markets, because understanding history gives us a roadmap for what's coming. In the late 70s, silver went from around $4 an ounce to over $50 in a matter of months. That wasn't just inflation. That was a supply squeeze combined with investment demand in an environment where people had lost faith in paper currency. The Hunt brothers tried to corner the market, and while their attempt ultimately failed, it revealed just how tight the physical silver market really is. When demand spikes, there simply isn't enough metal to go around at current prices. Fast forward to 2011. Silver rallied from around $8 to nearly $50 again. That move was driven by concerns about the financial system after the 2008 crisis, by quantitative easing programs that were flooding the world with newly created currency, and by investment demand from people who understood that paper assets were being systematically devalued. But here's what's different now. In 2011, industrial demand for silver was a fraction of what it is today. The solar industry was in its infancy. electric vehicles were a novelty. 5G didn't exist. The industrial consumption that's happening now creates a floor under silver prices that didn't exist in previous bull markets. Think about what that means. In the past, when investment demand cooled off, silver prices would collapse because industrial demand alone wasn't enough to support higher prices. Today, industrial demand is so strong that even if investment demand disappeared entirely, which it won't, silver prices would be supported by the sheer physical consumption happening across multiple industries. But investment demand isn't disappearing. It's just getting started. Let me paint you a picture of what's happening in the physical market right now, because this is where the story gets really interesting. Dealers are reporting delays in delivery. Premiums over spot price, the amount you pay above the official market price to actually get physical metal in your hands, have been elevated for months. That's not normal. In a healthy market with adequate supply, premiums are minimal. When premiums stay elevated, it's telling you something. It's telling you that the paper price, the price you see quoted on financial websites, doesn't reflect the reality of physical supply and demand. There's a disconnect between the paper market and the physical market, and that disconnect is widening. The COMEX, the exchange where silver futures are traded, has seen its registered inventory, the metal actually available for delivery, drop to levels that should concern anyone paying attention. Registered inventory represents the silver that can be delivered against futures contracts. When that inventory gets low relative to the open interest, the number of contracts that could demand delivery, you create the conditions for a squeeze. And we're approaching those conditions now. If even a small percentage of contract holders decided they wanted physical delivery instead of cash settlement, the system would be stressed in ways we haven't seen before. Now let's talk about the elephant in the room, the dollar. For decades, the dollar's status as the world's reserve currency has been taken for granted. Countries held dollars because they needed them for international trade, particularly for oil. But that system is changing. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems that bypass the dollar. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting payment for oil in currencies other than dollars. These aren't small developments. These are tectonic shifts in the global monetary system. When the dollar loses its privileged position, when countries no longer need to hold massive dollar reserves, what happens to all those dollars? They come home. And when they come home, the purchasing power of each dollar declines. That's not a political statement. That's simple supply and demand. More dollars chasing the same amount of goods and services means each dollar buys less. And when people realize their dollars are losing purchasing power, they look for alternatives. They look for assets that can't be printed, that can't be devalued by central bank policy, that have intrinsic value. They look for gold and silver. But here's where silver has a unique advantage over gold. Silver is affordable. A middle-class family can accumulate a meaningful position in physical silver. Gold, at current prices, requires significant capital to build a substantial holding. Silver allows regular people to participate in the wealth preservation that precious metals offer. It's the people's money. And as more people wake up to what's happening with currency debasement, as more people understand that their savings are being quietly confiscated through inflation, the demand for silver from retail investors will surge. Let me tell you about something that happened recently that perfectly illustrates this dynamic. A major online bullion dealer reported that they sold more silver in a single month than they had in any previous month in their history. Not during the 2011 spike, not during the pandemic panic, recently. That tells you something about where we are in this cycle. We're not at the end of a bull market where everyone's already bought. We're at the beginning, where awareness is just starting to build, where the smart money is positioning before the crowd arrives. And the crowd always arrives. That's how markets work. The early adopters, the people who do their research and understand the fundamentals, they position first. Then the early majority comes in as the trend becomes obvious. Then the late majority piles in as prices are rising and everyone's talking about it. And finally, the laggards show up at the top, buying at peak prices because they can't stand watching everyone else make money. Right now, we're somewhere between the early adopters and the early majority. The fundamentals are screaming that silver is undervalued, but the mainstream hasn't caught on yet. That's the opportunity. Now, I want to address something important, because I know some of you are thinking about your retirement accounts, about the wealth you've spent decades building. You're watching what's happening in the markets, the volatility, the uncertainty, the sense that the rules are changing, and you're wondering how to protect what you've worked so hard to accumulate. Here's something worth considering. If you're sitting on $100,000 or more in retirement accounts, there are strategies available that most people don't know about. Gold IRAs, for instance, allow you to hold physical precious metals inside your retirement account without triggering tax penalties. I put together a comprehensive guide on how this works, the pros and cons, what to watch out for. It's in the description. No obligation, just information. Because in times like these, when we're facing potential market collapses, geopolitical instability, currency debasement, having a portion of your wealth in assets that aren't dependent on the financial system's stability isn't just smart, it's essential. But let's get back to the silver story, because there's more you need to understand. The mining supply of silver is constrained in ways that most people don't appreciate. Silver isn't primarily mined for silver. About 70% of silver production comes as a byproduct of mining other metals: copper, lead, zinc, gold. That means silver supply doesn't respond to price increases the way you might expect. If silver prices double, mining companies can't just decide to produce more silver. They're mining for the primary metal, and the silver comes along as a secondary product. This creates an inelastic supply curve, which in economics terms means that supply doesn't increase much even when prices rise significantly. Compare that to the demand side, which is incredibly elastic. When silver prices start rising, investment demand can explode almost overnight. People see the price moving. They read about the fundamentals. They want to participate. That creates a feedback loop. Rising prices attract more buyers, which pushes prices higher, which attracts even more buyers. And because supply can't respond quickly, the entire move happens on the demand side. Prices have to rise enough to ration the available supply among all the buyers who want it. We saw this dynamic play out in the nickel market recently, where a short squeeze sent prices vertical in a matter of days. The London Metal Exchange had to halt trading and cancel trades because the price moves were so extreme. Silver has the potential for similar dynamics, but on a much larger scale because the investment demand component is so much bigger. When the silver squeeze really gets going, when physical demand overwhelms available supply, the price discovery process is going to be unlike anything we've seen in modern markets. Let me give you another historical parallel that's instructive. In 1980, when silver hit its peak, the world was dealing with high inflation, geopolitical instability, and a loss of confidence in paper currency. Sound familiar? But there's a crucial difference between then and now. In 1980, the Federal Reserve, under Paul Volcker, raised interest rates to 20% to break the back of inflation. They were willing to cause a severe recession to restore confidence in the dollar. Today, the government debt levels make that impossible. The interest payments on the national debt at 20% rates would consume the entire federal budget. The Fed is trapped. They can't raise rates high enough to truly fight inflation without causing a debt crisis that would make 2008 look like a minor correction. That means the path forward is more inflation, more currency debasement, more reason for people to seek alternatives to paper money, and silver, with its dual role as both an industrial metal and a monetary metal, sits at the perfect intersection of these trends. It benefits from the industrial demand that's growing regardless of monetary policy, and it benefits from the investment demand that's driven by concerns about currency debasement and financial system stability. Now let's talk about what this means for you practically. If you're holding significant wealth in paper assets, stocks, bonds, cash, you're exposed to systemic risk in ways that previous generations weren't. The financial system is more interconnected, more leveraged, more dependent on confidence than ever before. When confidence breaks, and history shows us that it always does eventually, the scramble for real assets will be intense. The people who already hold physical precious metals will be positioned to preserve their wealth. The people who wait until the crisis is obvious will find that premiums have exploded, that delivery times have stretched to months, that the metal simply isn't available at any reasonable price. This isn't fear-mongering. This is pattern recognition. Every major currency crisis in history has followed the same playbook. First, The authorities insist everything is fine. Then they implement policies that make the problem worse while claiming they're fixing it. Then confidence breaks, and people rush for the exits all at once. The time to position yourself isn't when everyone else is panicking. It's now, when you can still acquire physical metal at reasonable prices with reasonable delivery times. Think about silver as insurance. You don't buy homeowners insurance after your house catches fire. You buy it when everything seems fine, when you don't need it, because you understand that the risk exists whether you acknowledge it or not. Silver is wealth insurance. It's protection against the scenarios that keep you up at night. Currency collapse, banking system failure, geopolitical chaos, hyperinflation. You hope none of those things happen. But if they do, having a portion of your wealth in physical silver could be the difference between maintaining your standard of living and watching your life savings evaporate. And here's the beautiful part. Unlike traditional insurance, which is pure expense, silver has the potential to appreciate significantly even if none of the catastrophic scenarios play out. If we just see continued moderate inflation, continued currency debasement, continued industrial demand growth, silver prices should move substantially higher. You're not paying for protection that you hope you never need. You're acquiring an asset that has multiple paths to appreciation while simultaneously providing insurance against worst-case scenarios. Let me share something that might surprise you. Some of the wealthiest families in the world, the ones who have preserved their wealth across generations, across wars, across currency collapses, they hold significant portions of their wealth in physical precious metals. Not in ETFs, not in mining stocks, in physical metal that they control. They understand something that the average person has been conditioned to forget. Real wealth isn't numbers on a screen. Real wealth is tangible assets that have intrinsic value, that can't be hacked, that can't be frozen by a government decree, that can't be inflated away by central bank policy. The financial system wants you to keep your wealth in the system, in banks, in brokerage accounts, in digital form that they control. They make it convenient. They make it seem sophisticated. But convenience and sophistication don't protect you when the system itself is at risk. Physical silver is the opposite of convenient. You have to store it. You have to secure it. You have to take responsibility for it. But that inconvenience is actually a feature, not a bug. It means you control it. It means your wealth isn't dependent on the solvency of a financial institution or the stability of the banking system. Now, as we're approaching the end here, I want to bring this all together and give you a clear picture of where we stand. Silver is trading at levels that, relative to its industrial importance, its monetary history, and its supply constraints, represent extraordinary value. The fundamentals supporting higher prices are stronger than they've been in decades. Industrial demand is at all-time highs and growing. Investment demand is building. Supply is constrained. The monetary environment is conducive to precious metals appreciation. The geopolitical environment is unstable. The conditions are aligned for a significant move higher. But timing markets is impossible. Nobody can tell you that silver will double in the next 6 months or the next year. What we can tell you is that the risk-reward ratio is heavily skewed to the upside. The downside risk is limited by strong industrial demand and production costs. The upside potential is substantial given the supply constraints and the multiple demand drivers. From a risk management perspective, having exposure to physical silver makes sense for almost anyone concerned about wealth preservation. And here's the thing about wealth preservation. It's not about getting rich quick. It's about making sure that the wealth you've already accumulated, the wealth you've spent your life building, doesn't disappear in a monetary crisis or a financial system collapse. It's about being able to maintain your standard of living regardless of what happens in the broader economy. It's about having options when others are desperate. It's about sleeping well at night, knowing that a portion of your wealth is in an asset that's been recognized as money for 5,000 years and isn't going to zero, no matter what happens to the dollar or the banking system. For those of you who've watched this far, who've taken the time to understand what's really happening in the silver market, I want to offer you something additional. That free guide I mentioned earlier, the one in the description, if you're an American retiree with at least $100,000 in any retirement account, and you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference. No obligation, no sales pitch, just a detailed walkthrough of your options for protecting your retirement wealth in this environment. This is only available to people who've demonstrated they're serious by watching this entire presentation, and it's only available to American retirees who meet that minimum threshold. If that's you, check the description and mention you watched to the end. The bottom line is this: we're living through a period of monetary history that will be studied for generations. The decisions you make now about how to position your wealth will determine whether you're a case study in successful wealth preservation or a cautionary tale about the dangers of complacency. Silver isn't a magic solution. It's not going to solve all your financial concerns, but it's a tool, a powerful tool, for protecting wealth in an environment where paper assets are increasingly risky. The wealthy understand this. The institutions understand this. Central banks understand this. The question is, do you understand it? And more importantly, are you going to act on that understanding? While there's still time to position yourself advantageously, because the opportunity to acquire physical silver at current prices with current availability won't last forever. When the crowd figures out what's happening, when the mainstream catches on to the supply-demand dynamics we've discussed, the window will close. Don't let that happen. Don't be the person who understood the opportunity but failed to act. Your future self will thank you for the decisions you make today.